equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of Equity Mates, or should I say greetings, time travelers, and welcome to Investment Through the Ages, the podcast that takes you on a thrilling journey through the corridors of finance and investing. With the help of your inquisitive minds, we'll unlock secrets from the dawn of currency to futuristic financial trends. Ready to evolve from mere mortal to a seasoned investment time lord? Well, this is the podcast for you. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. I still have some getting used to these new and different intros, but that was a timeless introduction.
Timeless, yes.
Yeah, that was you being a time traveler.
Correct. Congratulations. You're good at this. We are time travelers.
Yeah, ChatGPT often gives the theme in
I
the
was
start
thinking
of
that,
it.
yeah. I'm gonna have to blank that out next time we do it.
Also, feel free to go more niche. Like, ask ChatGPT, what would an introduction sound like if Justin Bieber delivered it?
Sure. Well,
or like Nemo from Finding Nemo delivered it.
nice. Well, producer Sasha, you've heard the request, so
Give us a challenge.
next week. I don't know how I'd go doing a Justin Bieber specific intro, but hey, I'm open to anything.
Or you just read what ChatGPT gives you.
Yeah, that's very true. Anyway, if you've just joined us for the first time, welcome. This is a podcast that follows our journey of investing. Today we've got 3 segments. We're going to kick off with some earnings season highlights. We've got a call with a listener, Liam, to discuss the pros and cons of investing in ETFs or just owning the stocks individually. And then we close out with another question from a listener, this time from Alex, all around a comment that Ren had made on one of the most famous investing books. So we'll pick that up towards the end of this episode.
I'm sure it was a thoughtful and considered comment.
As always. Now, we must remind you that while we are licensed, we're not aware of your personal circumstances. So any information on this show is for entertainment and education purposes. Any advice is general advice. But we're back in the studio, and earnings season is well and truly in full force here in Australia, Ren, and overseas as well. But we've done a bit of
we kind of got through a lot of America. Oh, there's still some America to go. But yeah, we're in the final days of Australia as well.
We are. So we've pulled out some stocks that have caught our attention, both good and bad, and we're going to have a look at some of the highlights. And we've got to start with the stock of 2023, Ren, and that is Nvidia. It reported overnight, and there was much anticipation.
Here's the question. Did it live up to the hype? Now, for people who are unfamiliar with Nvidia, it designs the semiconductors and chips that they power a lot of things, but particularly this year, they power AI. The Nvidia's H100 chips are probably the most sought after piece of hardware in the world. They go for 40 grand a pop.
It's crazy.
There's a massive wait list to get them. And I think Saudi Arabia bought like 3,000 of them last week.
Thousands, yeah.
So that's like, $120 million.
Yeah.
Imagine just getting in.
Should we buy one?
We wouldn't be able to.
Oh, you don't think so?
I don't have 40 grand sitting around.
No, equity mates, put on the balance sheet. Surely it's...
You wouldn't know what to do with it.
Just sit it in our... just sit it here. It's an asset, surely.
Anyway, so Bryce, Nvidia reported, did they live up to the hype?
So what happened was a number of months ago, they reset expectations for the market and said that we are going to experience an absolute boom in revenue off the back of the demand for our product. And so the stock went nuts. So we assumed that the expectations were built in, and overnight they reported revenue of $13.5 billion, which was a 101% increase on last year.
Oh my God.
And not only that, but they did manage to beat Wall Street expectations. The expectations for revenue were $11 billion, so they beat expectations by $2.5 billion. And as a result, the stock has jumped in after hours trading. So the dream continues for Nvidia and its shareholders. It's one of the best performing stocks of 2023, incredibly hyped. It's hard to tell when this is really going to stop. And as you said, Ren, it has a product that is highly sought after, and with the rise of AI at the moment, it's hard to see where that ends. But it did manage to beat, and as a result, its stock price jumped, and we saw the ASX and the Nasdaq rise as a result as well. So full credit to Nvidia.
Yeah, full credit. Let's come back to Australia though, because there's so many companies that we could talk about, and it feels like we should cover off Australia in this episode. Now, we have both been away for a few weeks, and so we've missed reporting season, or most of the day-to-day of reporting season. And so we've sort of come back and we've had a look at results of companies that we own or companies that are on our watch list. And I guess before we get into the individual companies, what's been your general vibe? Opening the AFR for the first time after a few weeks in Italy, getting very tanned. What was your general vibe of reporting season?
General vibe, pretty neutral, to be honest. That was my vibe.
Yeah.
There was nothing that was like, we're doom, we're gloom, but they didn't also feel like, we're out of this and everyone's... It seemed like there's quite a mix of results across industry. But yeah, I didn't take anything too negative. What about you?
Yeah, I think that's the same. It feels like it feels mixed. Like, we'll get into some of the results. A lot of the results, profit was down or revenue was down for a number of notable companies, but it kind of feels like it could have been worse based on, cost of living, the economy, inflation, interest rates, all of that stuff. The ASX 200 is down 2% in the last month.
Yeah.
And we know that share price movements around earnings season or reporting season are more a function of expectation and how companies go against expectation rather than how companies are actually going and what their results have actually said. But it feels like it's okay, with the caveat that some guidance that we've seen sort of suggests that the worst may be to come. But I also feel that, like, if I was a CEO, I would be giving soft guidance just because there's so much. In the face of uncertainty, you go conservative, is kind of what I'm saying. Rather than, like, you would be a brave CEO to give really bullish guidance, just knowing that, like, the economy's a bit fragile and consumers are a bit fragile at the moment. Maybe I'm just being overly...
No, it's an environment where you can give... There's leeway to give soft guidance.
Oh, yeah. You're not going to get punished too hard for giving soft guidance. All right. So I guess that's the general vibe. It's like things are okay. And like some companies are reporting good results. Qantas, best profit ever, but we'll get to that. But it's like what's to come is sort of... There's a bit of uncertainty, a bit of concern. So let's get into it. What are some companies that caught your eye?
Well, one that caught my eye, I'm not invested in it. I don't follow it often, but we've had people on the show talk about it, and it was part of the WAX back in the day.
For people unfamiliar, the WAX?
WAX is Australia's equivalent of the FANG. It was WiseTech, Altium, Appen, Afterpay, Xero.
Nice. So Australia's like high-flying tech stocks.
Yeah, which arguably needs to be redone now. But
because Afterpay.
Yeah, Afterpay's gone. WiseTech got pumped, which we'll get to in a second.
Still a great company.
Still a great company. Xero doing well. Anyway, Altium is back. It makes software used by electronics designers, so chip makers. It's one that was spoken about in the...
To help design the circuit boards.
Yeah, so one that is part of the AI boom, and they've been able to transition their business to a cloud-based software, and the main product is called Altium 365. And it reported great results. And as such, its shares jumped 20%. But what is interesting is this is a bit of a turnaround story, because it was only a couple of years ago that Altium was in takeover talks and was sort of on its knees. So they've certainly been able to turn it around and benefit from the AI boom. So that caught my eye, but as I said, not one that I'm invested in, but I'm sure there are plenty of Equity Mates community members that do have their eye on this one, given that it's spoken about on the show.
I read some analysis from Jarden, the investment bank. Shout out to Elise Kennedy, who's the tech analyst over there.
Yeah.
Her thoughts, we continue to be cautious as Altium is increasingly reliant on price to drive its aspirational targets. The PCB, which is printed circuit board, the PCB market is mature, and we are concerned about the sustainability of ARPU, which is average revenue per user, against strong competitors with a smaller total addressable market than tech peers. So your headline was Altium was back. Elise's caveat is just...
potentially back, I said.
is just be mindful.
Well, it's back from a share price point of view.
Yeah, no. Hey, I'm not disagreeing. I just...
No, it's good. It's good.
I just had something to add.
Good input. But Ren, we've got to move to, Coles and Woolworths. They've both reported in the last few days at the time of recording, 24th of August. And there's been some interesting takeaways.
Yes.
So firstly...
A lot of literal takeaways.
Yes, literal takeaways. So firstly, both of them posted profits. Coles posted a $1 billion profit on the back of bumper sales, and Woolworths posted a $1.6 billion profit. You know, they both benefited from price inflation, and also both are seeing a shift in consumer buying behavior and buying more of their own brand products given the cost of living crisis.
Yeah. I mean, you would expect Coles and Woolies to do well in this environment as people tighten their belts, they stop going out as much, they stop, and you know, they buy more groceries and cook at home. They stop going to the pub as much, and instead they buy booze and drink at home.
Yep.
And then also, rather than buying branded versions of alcohol and groceries, they buy the own brand versions, and that's good for Coles and Woolies as well. So this is like big box supermarkets are as consumer staples or like defensive as you can be, and not surprising.
Yeah. But what was interesting that came out of this is they both made it clear that they have seen a significant increase in theft.
The literal takeaways.
Literal takeaways. Both are seeing, you know, above average, more than above average. Coles has experienced a 20% spike in theft, and Woolworths has also said that theft is now becoming a major issue because of the cost of living pressures.
Yeah, it is fascinating. The whole theft from supermarket story is a really, like, just, it's fascinating. It's organized crime.
Yeah.
Like, there's obviously, you know, you scanning your broccoli as brown onions, and no reaction to that. Okay. Like, but it's organized crime, and then there's huge rings of supermarket thieves, and then they go and sell those groceries in like
the black
market supermarkets.
Yeah. Yeah.
It's wild.
It is wild.
Like the Lost team when I was at Coles, you know, they would work with the cops and they would break up like organized crime rings.
Yeah.
You just don't think that. You just think it's
one single person.
It's scoundrels scanning everything as brown onions.
Yeah.
Yeah.
It's unbelievable. So both are facing it. It's hurting their profit margins. Interestingly, though, Coles came out and despite profit, their share price sunk 6% on the news. Woolies came out and their stock rose 3% on the news. So mixed results from a share price point of view. But Ren, something that I found, given that I used to work at Woolies, found alarming, and reading some of the investment calls, a question came from a well-known analyst, David Errington. Did you know that there's been 2 deaths at Woolworths this year?
Oh, no.
Yeah. So someone was crushed by a floor cleaner in a store, and another person was crushed by falling pallets in a distribution center. Yeah.
Wow.
2. And so the analysts were pumping Brad about how can you still be giving out bonuses to management and stuff when
people
have died. And so he's stripping back, still paying, but they're stripping back bonuses, and they're doing this extensive review of every single piece of equipment in the business, and like overhauling safety, and like Brad was obviously like, there is no monetary compensation for lives, but I was just like, wow, like heartbreaking to hear.
Very intense. So 2 companies that caught my eye. Obviously, housing is front of mind for everyone in Australia, and in particular for you and I at the moment, because we are taking the first tentative steps on our property journey, which is figure out how much we can borrow and then realize what that actually gets us, which isn't much. But when you're thinking about property and it's a reporting season, there are 2 companies that we can look to get a sense check of the property market, and they are the 2 big real estate listing portals, REA Group, which is realestate.com.au, and then Domain. Now, both of them had down years. So, well, at least from a profit perspective. REA Group's profit was down 9%, while Domain's profit was down 28%. And Domain, well, I mean, it was because of a drop in listings, in real estate listings. Yeah. So there's a couple of takeaways. The first one is, you know, sometimes property companies do struggle. Surprising in Australia.
Surprising.
But often when we've spoken to experts or in things we read, you hear about if there's 2 big companies, the better company or the bigger company will often trade at a premium. And so people often think, oh, I'll get the second one because there's a bit more value there. But the lesson that sort of is taught over and over again is that like you want to be investing in the best in class because they're going to be more resilient and they'll grow more. And then it's just, for me, it's interesting that when you look at this REA group, the bigger, seen as the more premium, often trades at a higher valuation to Domain. But when things got tough, their profit only fell 9%, whereas Domain's fell 28%. A thesis, which I'm just throwing out there, you'd have to test, is that if people decided, I don't have the money to advertise on both platforms, I'm just going to advertise on the platform where there's more users and there's more listings, and that's REA Group. And so maybe that's why they weathered the last year a little bit better than Domain.
Who even uses Domain, honestly?
So Alice, my partner, uses Domain and sends me listings on Domain. I use REA.
It's so much better.
I'm also a shareholder of REA, full disclosure, but I've downloaded Domain.
Oh,
because I am nothing if not
into the dark side.
Hey mate, it's all about compromises, you know.
That's fair cool. Why doesn't she compromise and get on REA? What you need to do is start pumping her with links.
I have no response to that.
Nice.
All right, what are some other companies that caught your eye?
One that I just thought was interesting. You don't often hear companies apologizing too much, but Domino's came out and apologized for putting prices up too much over the last year because of inflationary pressures. They realized that they put them up so much that it has impacted their sales volume. And so they're now going to reduce their prices, but not necessarily the pizza price, but some of the surrounding service costs. So they're removing their delivery service fees and reviewing, I guess, some of the input costs, because I think they went a little bit too hard on the increase in prices. So I just thought that was interesting. And another one, Ren, WiseTech. This is just classic markets. Listen to this. Revenue up 29%, earnings up 21%, dividend up 31%. However, slightly missed expectation, stock down 20%.
Yeah, it's a classic.
Classic.
Yeah, expectations
are... Solid results. Just misses expectations and gets pumped. But WiseTech continues to be one of Australia's leading tech companies.
Yeah. There was a classic example of that, the strangeness of earnings season, that was shared on our Instagram. Walmart smashed expectations and Target had a weak second quarter, but Walmart was down 2% and Target was up 2%.
Classic.
And that is even Walmart didn't just smash their previous year, they smashed expectations, but that was still down.
That's weird. Yeah.
I think it must have been about guidance going forward. Yeah. But it's just like movements in share prices can be so misleading to like what's actually happening with the underlying business.
Absolutely.
Yeah.
All right, Ren. Well, before we move to our second segment with a call, what else caught your eye?
So a couple of ones that I'll just quickly rip through. CSL, Australia's biggest healthcare company, was previously Australia's biggest company. They just continue to go from strength to strength. Despite a warning from the company last quarter, their revenue was up 31%, profit up 20%, net profit after tax up 8%, and a strong outlook going forward. It's a pretty amazing story that CSL is building. Temple & Webster, we had a bit of fun with this online furniture retailer because they were one of the first companies in Australia to really try and ride the AI hype train.
Still are.
They are?
They still are. They're still very much in the press about it.
Okay. Yeah, they reported a 7.2% decline in sales and a 30% decline in profit.
I tried to find what it is that, like, all they say is AI.
No. They've said it.
Yeah. It's just changing the description of all their products.
Yeah. They've rewritten all their product descriptions with AI, and I think they're using it in their customer service stuff as well. Like there's a chatbot and all that stuff.
Right.
Yeah. Hey, you got to do what you got to do.
Yeah.
ASX caught my eye. The stock exchange itself is a listed company. Its profit fell 38%. Due to costs related to, no surprises for guessing, their failed chess replacement project. So that is just the gift that keeps on giving. I would assume it's probably now all in the rear view. I would assume. Qantas reported record annual profit, a $500 million buyback. It is raising some questions now about the amount of money they got during COVID, which... I get. It's also a bit tough because it's like that was then and this is now. Yeah, if they didn't have money then, they didn't have money then. But it is maybe drop the price on some of your flights, Qantas.
Yeah, I mean, apparently the level of complaints against Qantas that the government are just burying is getting ridiculous.
No way.
Yeah, like all-time highs kind of vibe, and there's...
We did an episode on the dive, and by we I mean I was on holiday, so I had nothing to do with it. But Sasha, our producer, did an episode on the dive where she spoke about ghost planes.
Yeah.
Because Emirates want to do more flights to
Qatar.
Is it Qatar?
Yeah, I think it's Qatar. Yeah.
A non-Australian airline wants to do flights. I think it was Emirates.
No, it's Qatar.
Okay.
Yeah.
I was on holidays. They want to do more flights to major Sydney airports like Melbourne and Sydney, but they can't. So they're doing these things where they say they're flying to Adelaide, but drop all the passengers off in Melbourne and then fly an empty plane to Adelaide to get around it. Yeah. But they've asked the government for more flight slots and they can't get it. And it's like, why? Like, let competition in.
I know.
Put some price pressure on Qantas.
The government says jobs. But anyway.
One more notable name and then let's move on. Magellan.
Yeah.
Share price up 18%.
Yeah, I did see that, but I didn't want to say anything about it. Yes. Anyway, so if you have a stock that caught your eye during reporting season, please jump into the Equity Mates Facebook discussion group. We'd love to hear about stocks that potentially haven't come across our desk and share them with the Equity Mates community. Speaking of community, we love getting our questions from you guys. ask@equitymates.com is where you can leave them. And we'll do our best to answer them and get you on the show. We have one that's come in today from Liam. And Ren, he is in a bit of a pickle. He is very bullish on some of the big tech companies, Apple, Nvidia, Microsoft, and Google, and has belief in them and has everyday experiences with a lot of them. But he's trying to understand what's the best approach around owning them individually or finding an ETF that still gives decent enough exposure to them and figuring out what is the best investing approach. So we're going to give Liam a call right now to chat this through with him.
Liam speaking.
Liam, it's Bryce from Equity Mates. How are you going?
Good, mate. How are you?
I'm well. I've also got Ren here.
Hey, Liam. How's it going?
Good. Thanks, Ren. How are you?
Good, mate. Good. We got your question. Thanks for sending it through.
So I guess... where are you sitting with this? The tussle between owning companies outright and wanting to find the perfect ETF that has just the companies that you want in it.
Yeah, I feel like you should be able to make like a custom ETF. That'd be pretty cool.
Good news. We won't get sidetracked with it, but that is coming.
Okay.
I think it started in the US. But anyway.
Yeah.
It's a while
and
away.
you can like pick and choose the holdings yourself.
Yeah.
Yeah, right. Okay, cool. Yeah. So I recently, a little while ago, I suppose, I sort of jumped out of markets for a little bit. We purchased a house, so I sort of needed the cash, and that was the purpose of it.
Fair call. Congratulations.
Yeah.
Congratulations on doing that, by the way.
Must be nice.
Yeah.
Being in real estate myself for a few years, it kind of, a few tricks of the trade, things like that on the inside, so it makes it easy.
Well, pass them through our way.
Yeah.
We're trying to find a house at the moment.
We'll edit this bit out.
Okay.
Nah, let's stick with stocks, and then we'll see where we get to with property.
So I'm sort of in a position where looking to jump back in, and I've had a look around, and I suppose the news is at the moment that the top 8 like FANG plus stocks, Facebook, Apple, you guys know,
Yeah.
sort of kind of dominating that NASDAQ increase, whereas a lot of the other companies in that top 100 are sort of just, they're doing all right, obviously, but nowhere near the level of what Nvidia or Microsoft and Apple are doing at the moment. Like you guys always say, if you know a company that you use and you have belief in, go for them. Like, I use Apple every day. I've got an iPhone. I'm a massive Apple fan. Microsoft, my office, all we use is Microsoft products. Google, it's Google, of course. YouTube, all that. Nvidia, I'm a gamer. So, they kind of dominate that area compared to AMD, in my opinion. So I have like a personal tie to them and use them every day of my life. Whereas while I also use Facebook, I'm not a fan of Zuck's and all of his sort of outspokenness, and I think he causes a lot more turmoil than what it's worth. Same with Elon as well. So that's kind of my mindset is like, obviously owning shares internationally, there's all that extra level of bureaucracy with US tax filings and all that sort of stuff. Is it more efficient to just sort of bite the bullet and take an ETF with all of them in it and just accept that you're going to get some other ones that you might not be super stoked with, but, at least it's easy and efficient? Or is it just better to get them individually and just hold them?
So I think there's a few elements to that question. I think on the tax thing, first of all, you have to fill out the W8 Ben form, but it's not difficult.
I'm going to go as far as saying that the brokers these days do it on your behalf when you sign up. There's a signature required, but you're not in the weeds when you're signing up to these brokers.
So my gut is don't let that
definitely don't
be a deciding factor.
No.
Yeah.
It's never been a hassle for me over my years. I've never gone, damn it, I didn't own overseas stocks because the tax on this is too confusing.
I reckon back in the day when we were with ComSec, they made you print it out and sign it and then probably post it in. I have a vague recollection of that. But yeah, since then, with all the online brokers, it is pretty easy. The way it works is, so you basically establish yourself as a foreign investor, and Australia and the US have a tax treaty. When you get a dividend from a US stock, you still pay 15% tax. It's 15% is withheld. But if you sell, there's no US tax. And then you obviously claim it back in Australia. So a little bit on the dividends, but on the capital gains with individual US shares, you're okay.
I think also for me, I'm cheering at the moment because a lot of the US investments that I have are also benefiting from the Australian dollar being down the drain in terms of, so you've got that USD sort of currency sitting in there. Not that I really take that into consideration when buying. It's always from the investment thesis of the stock. But if I were to sell those, take advantage of a low Aussie dollar.
I guess that would be the same with US ETFs though.
Yeah.
Because like even if you buy, like FANG Plus, for example, it's listed in Australia, but you get the stock, the underlying stocks are in USD.
Just make sure it's not hedged.
Yeah. All right, so let's actually get to answering your question because I feel like we're waffling a bit. So I feel like you've got strong feelings on this, Bryce.
I don't actually have strong feelings. My sense is like if you have high conviction in a handful of stocks, and why not go for it? We've just come off an interview actually where the expert was saying like you're better off having high conviction on a fewer stocks than having multiple positions across many different stocks because you run the risk of underperforming.
Well, and just not knowing them as well.
Exactly, and needing more time to research individuals. And I think that's where ETFs obviously help. But if you have high conviction on 2 or 3 stocks, there's nothing wrong with building up large positions in each of those. My counter argument to that is the stocks that you've spoken about are the ones that are driving this huge returns through the NASDAQ, and the ETFs that you buy obviously give you incredible exposure to those companies. And should they over time not be the ones driving growth on the NASDAQ, you're still going to be owning the companies that eventually replace them and do. So that's the longer term play, but I don't know if I've helped you there at all. I personally own FANG Plus because I've had this predicament. I only own now Alphabet and Apple outside of my FANG Plus, but I've gone heavy into FANG Plus because it's equal weighted and it's all of the companies that I want to be invested in. Yeah, so I kind of have hedged my bets on those companies in there, but to your point, they're all the companies that I would want to invest in outside anyway. What about you, Ren? How do you think about it?
So a couple of thoughts. I agree with your sentiment generally that it's like if you have conviction on a certain number of companies, you should just invest in those companies rather than diluting that conviction with other companies that you don't believe in. And, looking at FANG Plus, it's got a lot of the companies that you mentioned. It's got Alphabet, Nvidia, Apple, Microsoft. But you mentioned that you thought Nvidia was a lot better than AMD. Well, AMD is in FANG Plus as well. And, if you don't believe in Meta and you don't like Zuck and his cage fighting antics with Elon and all of that, then, it's in there as well.
But you may not like it, but you would have benefited from the 258% increase that it's gone through over the last 12 months. So,
and I think for me, like my approach with something like this and how I do invest, it's kind of like the best of both worlds approach. So I don't own FANG Plus, the ETF, but I own, just like generic US ETFs where those big tech names move it, and they're the majority of the ETF, or they're at least the biggest weightings in the ETF. But then for companies where I have high levels of conviction, I then buy them individually as well to give myself more exposure to that. And so I think one of my biggest individual stock holdings is Alphabet. And so, I obviously own that in ETFs, but then it's like, because I have conviction, I'll buy it on top. So I guess my answer to the question would be like, you can have the best of both worlds, and you can get the, own a little bit of everything, and then whoever wins, I benefit, world of ETFs and indexes. And then you can also invest where your conviction lies with individual stocks.
Yeah, that's probably a good idea. I mean, I like the idea of having the best of both. Own a little bit of everything, but then increase your own personal weighting by buying those ones individually.
Exactly. Yeah.
The good thing is they're all US, and so depending on which broker you use as well, they're going to be zero commission on brokerage, so you can dip in and out of them with very low cost as well.
I've been thinking about the build your own index question that we started with as well, and I believe you probably know this better than me, Bryce, but Sharesies, I think you can choose a basket of stocks.
That is correct.
And then like set up auto invest with that basket of stocks. So essentially that is build your own index, sort of. Yeah,
let's keep that at a high level, because I'm not quite certain on the execution of it, but I think they do have a functionality similar to that.
Maybe let's just say this, Liam. Maybe do your own research on Sharesies as a broker, because they may have partially solved the problem that you're trying to figure out.
Oh, yeah.
Funnily enough, I am like most people, I've got multiple accounts with multiple brokers, but I have used Sharesies in the past, and I do believe they have a that sort of thing, like you said, Ren, where you can auto invest in a select few US stocks and just keep it ticking over.
Yeah.
Nice.
Okay. Yeah. Nice. I guess it doesn't do the sort of the weighting of indexes, but I mean, it's halfway there. Yeah.
Yeah. I mean, I suppose the whole ETF sort of debate versus the individuals was mostly around, one, the added convenience of just not having to worry about that exchange sort of copping fees, exchange changing and all that sort of stuff, as well as all the tax implications. But I suppose I didn't really understand the tax stuff myself.
So here's the thing though, with this ETF thing, if you have a broker that gives you zero brokerage and auto invest, you can create the exact same thing as a...
No, there's one other thing that you need, which is like a really low minimum investment. Because that's the other benefit of ETFs. That it's
true,
like,
you can put in like $2 or whatever.
Yeah, and you get access to everything. So if it was a broker that offered you like investing from $1, and then you could spread it yourself. But if it's like minimum investment, $500 like ComSec, then you're blown out.
Yeah, well, there are the online platforms to let you do it. But anyway, going down a rabbit hole. But Liam, I hope we've been able to provide some clarity. If not, just it's been fun chatting it through, and we really do enjoy talking to the Equity Mates community. So certainly appreciate you sending the question in and supporting the show.
Always. Thanks, guys, for reaching out and having a chat. It was fun.
Well, good luck with it. Let us know what you decide on, and we'll have a chat about it on the show next week.
All right, beautiful. Sounds good.
Well, a reminder that if you want to ask a question, ask@equitymates.com is the email, or jump onto our socials and send them through. Sasha, our producer, will keep an eye, and we'll do our best to answer them. Make sure you're also subscribed to our weekly email, where you can ask questions as well, and we'll get some of Australia's best advisors to answer them. You can subscribe on our email. But Ren, we're going to take a quick break, and on the other side, we've got another question from Alex around a comment that you've made about one of the most famous investing books of all time.
Yeah, in the break, I'm going to remind myself what that comment was.
All right, well, we're back. We've spoken about earnings season. We've chatted to Liam, and now we've got a final call question coming in from Alex. So let's give it a listen, and then we'll get stuck straight in.
Hey, Bryce, Ren. I'm relatively new to investing, and I've been getting a lot of value out of the Getting Started and Investing podcast. I've got a question specifically about approaching older investment books, The Intelligent Investor, specifically by Benjamin Graham. And in one of the recent podcasts with James Reynolds, Ren, you made a comment that caught my attention, and excuse the paraphrasing, but essentially it was so many people start investing, get told to read Intelligent Investor, get introduced to traditional value investing, then start trying to apply this to the real world and try to find companies trading below their net asset value, etc. And you quickly realize the rules of the game have changed, and deep value plays that made sense in those days don't make sense today and have been arbitraged away. So, of course, I've recently bought this book about the day before I heard this podcast, and I'm curious what I should take away from reading it in light of that comment, particularly how I should interpret the idea that the rules of the game have changed and deep value plays that made sense in those days don't make sense today. I guess in your view, is a book like this still worth reading? If it is there a particular approach that I should make with adjustments in mind to avoid pursuing strategies that might lead to false hope? Really greatly appreciate any guidance or insights you could offer on that. Thanks, guys.
Nice. Great question. Thank you, Alex. Love being kept honest here at Equity Mates Investing. So it is a book that I think you and I both picked up in the early days, Ren, and tried to give a crack. But
it's a tough first read as well.
Very tough, but it's tough, but it is funny that it's one of those ones that always gets put up on lists of like best book to starters and starting to invest, read Intelligent Investor.
Yeah. And like it is a great book.
Yeah.
But there's so much stuff I get to plug in this. So in a recent Equity Mates email, every Monday we share 5 of our favorite pieces of content that we've come across, and we do a bit of a write-up on them. And then every Thursday we share a question and we get it answered by a financial advisor. In a recent Monday email, I shared an article, Investing's Big Blind Spot. And just one of the challenges of investing is the longer something has worked, the more likely it is to stop working. And that is because, early days, a different asset class or a different investment strategy will be discovered or will be thought of. And the early adopters of that strategy will make a lot of money because it works. And then more and more money and more people will flood into that market, and the opportunities that they have to invest in will become worse and worse just because there's only a finite amount of any opportunity. And then, but there'll be so much hype and the early adopters will have made money, but eventually that opportunity will go away. It'll be arbitraged away, and any value or any opportunity will be priced out, essentially. Does that make sense?
Yeah.
And that is essentially what's happened to Benjamin Graham's style of investing, that net deep value style of investing. And you don't have to take my word for it, because this is the second thing that I get to plug in our most recent book, Don't Stress, Just Invest, available in all good bookshops now. We actually pulled out a quote from Benjamin Graham himself. So Benjamin Graham wrote Security Analysis in 1934.
Oh, another.
Oh, that's even harder. That's
don't go there.
Yeah. That's like 1930s textbook.
Yeah.
So he wrote Security Analysis in 1934, and then The Intelligent Investor 15 years later in 1949. He taught at Columbia. He taught Warren Buffett, and early days of Warren Buffett's career, he adopted this deep value cigar butt style of investing. But towards the end of his life, even Benjamin Graham realized that the style of investing that he pioneered was being arbitraged away. And, the longer something has worked, the more likely it is to stop working. Here's what Benjamin Graham told the Financial Analyst's Journal towards the end of his life. Quote, "In the old days, any well-trained security analyst could do a good professional job of selecting undervalued issues through detailed studies. But in the light of the enormous amount of research now being carried on, I doubt whether in most cases such extensive efforts would generate sufficiently superior selections."
There you go. From the man himself.
And if you think about him saying that then, when there was just more and more focus and more research,
Imagine now.
Think about today with like quants and the amount of computing resource that is being put towards finding those deep value opportunities. And that isn't to say they don't exist. This is a third thing I get to plug.
Yes.
We've recently come off an interview with Maroon Yunus, who's the co-portfolio manager at Fidelity's Global Future Leaders Fund. We unpacked 2 companies in his fund. One of the companies, a Japanese company, fits Benjamin Graham's style of deep value investing, where you can buy $1 for 50 cents. And so those opportunities do still exist. It's just the number of them are far less. And where they do exist, they often get realized and, the price gets bid up faster.
Yeah.
And so it's not to say that the book doesn't have merit or the investing strategy doesn't have merit. It's just that a lot of people, myself included, I reckon you as well, Bryce, because I think we were living in a share house in Canberra together when we were trying to do this, is we'll read the book and then we'll get a stock screener out and try and find these deep value plays. Yeah. And the fact of the matter is there's just less of them. And where you do find them, there's often other problems with the companies.
Yeah.
There's a reason that they're so cheap.
Yeah.
Yeah.
Well, that certainly does answer, in my mind, Alex's question. Alex, thank you for sending that in, and I hope it does help. Still give the book a read, obviously, taking into consideration everything Ren just said, but also don't stress, just invest is probably a more relevant book for today's day and age.
It won't help you with individual stock picking.
That's true. That's very true.
But it'll help.
It'll help.
But yeah, I think still read the book, still learn as much as you can. John Hempton, the Australian investor, has this great quote that that's always stuck with me. He said, "Every new investor should read 5 investing books. It doesn't matter which 5, just read 5."
There you go.
And I think there's so much truth to that, because even if it's old, even if the markets have changed, there's so much to learn about just how markets work and how to think about investing in stocks. So.
Well, we've got a recommended books page on our website. If you're looking
That's
for
the fourth plug in this segment. We're killing it
If you're looking for some inspiration, head there. Also, jump into the Facebook group. Our whole episode on Thursday is inspired again by an Equity Mates community member. We love hearing from you. Keep the questions coming. This Thursday, we're really digging into ESG and how it can be sometimes, I guess, contradictory, counterproductive to, I guess, the business outcomes. So, or
environmental outcomes.
Going green.
Yeah.
So a lot coming up. It's good to be back in the studio. We do hope that you enjoyed the Is There Money In series. We'd love to get some feedback on it. We know it wasn't for everyone. We will be back with investing content, but we are back with investing content. We'd just love to get your feedback because it is important to us. So please, if you want to email us, contact@equitymates.com. You can.
We'll have a Google form to collect some feedback that will be on the Facebook group and on our Instagram. So more plugs. Anyway, we'll leave it there, Ren. It's great to chat as always, and we'll be picking it up on Thursday with Kelly Shue, Professor of Finance at Yale.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.